Uh, Hi guys, welcome to this webinar. I hope everyone can hear me. So I'll probably kick off the presentation right now. Thanks for making time. My name is Yagnesh Sanghrajka. I am founder and CFO of 100x.vc. 100x.vc launched last year and has started investing through iSAFE. And we wanted to kind of do this masterclass. We've done a lot of masterclasses for founders, but we wanted to do it for angel investors, family offices as well. So here am I in front of you guys. Hope this is worth your time and also your money later. So yeah, so let's just kick off on the thing and just few instructions here. We've got some questions already, so I've tried to address some of the questions in the presentation itself. However, if there are any questions at the end of the session, please feel free to kind of type that and send it out on chat. I'll probably do my best to kind of reply to those questions. We'll start off with the presentation. So, second. Yeah, so just before we kind of jump on to the iSafe discussion, just thought we'll give you a slight background on what's the kind of angel list scenario out there in India. I mean, technically speaking, if you really LinkedIn search in LinkedIn, you can see about 6,000 angel investors all over in India. However, if you really go to see the deals that we've seen across from angels, there are probably hardly 2,000 odd angels who probably are active. So yeah, that's the kind of community we are talking about. So just to give you a little background now, before we jump ahead, just thought to since we all probably are in investing, looking at various companies, evaluating deals all the time, what kind of founders you want to really back, right? So these are a few things that you take into account. One, obviously, there has to be a rockstar tech team. As software is leading the world, and right now also we're communicating through softwares, and more so in current times. I think software and tech is going to overtake almost everything. So, and then is there a large market opportunity? Is there a wow product with an IP? Uh, what's the solution that customers will buy for or will use? And then market validated business model. So we just don't want a business model which is on paper, but yeah, it should be repeatable, scalable. The unfair advantage to make profits, and that's the whole point of a venture, to make profits and become scalable. Uh, make a lot of money for the founders as well as for the investors. There has to be a skin in the game by the founders. So it's very important. We see uh, that there is skin in the game by virtue of investment, years of effort having put into by way of time as well as money, and that the X factor which kind of makes us lean towards the deal more than any other deal, which kind of comes in with a lot of communication skills by the founders. So that's what it is. And so let's look at the evaluation scorecard. We've tried to put some weightages, and what we see here and in our own experience of funding startups, management team basically tops it all. You basically focus on the management team. There's got to be a lot of focus there. You need a very solid team with complementary skills, so that all the areas of business, be it operational, technology, sales, strategy, all of them are well covered by the team, and hence the focus is on the team. And as many co-founders there are who can join in with complementary skills, all the more better. Secondly, obviously the size of opportunity, the product, and the marketing and sales channels. Now these would probably take equal weightages, as you can see, 15% each. So probably these all three go hand in hand in probably deciding the attractiveness of a particular opportunity. Uh, yeah, and then the competitive environment does matter. We need to know, who the startup is competing against, what are the USPs as compared to competition, And then there are other factors and stuff of like a lot of corporate governance stuff around the startup, and uh, those things form the other things. uh, yeah, we've been seeing a lot of women founders turning entrepreneurs, so that's a healthy trend. So yeah, technically if there's a woman founder complementary with a another founder, that kind of helps because it gives just another perspective also to the whole management team. Experienced team obviously are preferred. They stand better chances at fundraising. So these are certain things that probably we look at. Uh, so how does like each asset class basically has kind of construction portfolio construction. So how does one go about creating a portfolio? So obviously in startup investing, the investment horizon is minimum 5 years. Uh, there has to be an exit potential because we are coming in early. The exit potential cannot be anything that is compared to listed markets or any other asset class. It has to be in the range of 10x to 50x at the most, and sometimes more as well if you're lucky. Asset allocation here should not be more than 5 to 15% of the total assets. So since this obviously is a risky asset class to begin with, uh, there has to be probably keep some money for the second round as well if possible. And we've kind of just segregated the ticket sizes and the capital required that you can keep aside for per year between angels and family offices. So uh, typically what you would be keeping aside is between 10 to 50 lakhs in a year, wherein you could do mostly 2 to 3 investments or maybe more if the ticket size is less. Family offices tend to put more money on the table with more deals, and the check size is also being higher. So yeah, every investment that we make, an angel investors makes, comes with an exit strategy, and basically there are three exit strategies here. One being the financial exit, where basically you have a VC or an institutional investor come in at a later round, maybe a series A or B or C, and then buys out basically the initial equity that angel investors and family offices tend to invest. So this is possibly the best exit that angel investors look at because these are double-digit exits typically, returns that you get when you exit. So this is probably the best outcome. Next in line basically is the strategic exit, where there's a strategic buyer who likes your startup and results in your stake being bought over by the strategic investor. This leads to basically an average exit, which probably gives you limited cash returns, but there still are positive cash returns, and probably more than what generally any other safe asset class would give you. So strategic exits do result in great outcomes sometimes. The third could be, and basically a survival and an exit strategy where there's an acqui-hire. Uh, a bigger player probably likes the team, but can't probably invest in the existing startup. The startup is going south, and then the forced merger or an acqui-hire happens with an equity swap, just to kind of prevent erosion of capital, and this probably could see capital protection at best. So these are three exits, and the other ones obviously are no exit, where there's nowhere to go and the runway has dried up and the startup closes down. So that's your worst case scenario. Going to the next one, we just thought we'll put into place in terms of what each timeline does in every exit. So, typically when the exit happens between 1 to 3 years, you could look at a 2 to 3x. If an exit happens in 4 to 5 years, 5 to 20 times exit. Uh, and yeah, if you're lucky, it could take 8 years or more if you have that patience. You could have a 30 to 100x. And then if you basically believe it's a unicorn and stay long enough, and still are lucky, then it's a 100 plus X kind of unicorn outcome, which basically takes nothing less than 10 to 12 years. So these are the indicative timelines and the exit outcomes, uh, provided obviously your startup kind of takes it ahead, makes efficient use of capital, and grows the business and all that. I just thought we'll kind of touch upon why these startups fail, and we know some of these reasons pretty much, but I just thought we'll list it out there, and you would have seen some of your startups having faced the same problem. Most common being, sometimes there is no market need and something that is felt around the founders. They try to build, and there's probably no real market need. uh, a lot of them run out of cash because of bad cash planning, bad financial management, not really kind of keeping those buffers in the system to kind of have enough runway till your next funding round happens. Those kind of things. Poor unit economics, we've seen that quite a few times. And that can be tricky as well because unit economics changes pretty fast with volumes. So there has to be a clear sense of where your unit economics is going with time experience. Uh, Poor marketing promotions, the product may be brilliant, but you don't do good marketing despite having the budgets. The investment doesn't happen in the right pockets, and hence, despite of money being available, the investment doesn't yield good outcomes because there is no growth, proportionate to the capital invested by the founders. Sometimes technology innovators tend to ignore customers request. They are in awe of their own product and hence ignore customers requests, wish lists and stuff, which basically becomes harmful in the long run, and they cannot scale because customers need is unmet, and that's precisely the reasons why startups kind of fail. So that brings me to kind of mostly kind of the end of the basic kind of premise. Wanted to discuss on what is the need for this masterclass. Why do we feel this masterclass was important, and linking it to what we are talking ahead in the few slides ahead. So yeah, in the angel, as you would know, angel investment landscape has significantly changed. Angels have played prominent roles now in the Indian ecosystem, startup ecosystem. From less than almost 50 angel investors a decade back, we now have active 2,000 angel investors, as I spoke about in the previous slide. Looking at various performances recently, this being ideally, the time where you could really compare stuff. Listed markets have given negative returns, for a decent time. Mutual funds, commodities, real estate, dragging down for quite a few years. uh, we are seeing more and more kind of asset allocations from family offices, angel investors, corporate VCs, coming more closely to evaluate startups as an emerging kind of asset class. And hence, and what happens typically is that angel investors, in most cases, as you would all know, are past entrepreneurs, current entrepreneurs, or executives with high domain expertise, wanting to invest in startups with their respective sectors, uh, but however do not really possess the skills to kind of have time to deal with agreements, long drawn clauses in the SHAs, and that kind of makes it more difficult to kind of close deals. Angel investors having less in their bandwidth to kind of make sure that the documentation is right. And that's the reason why we feel iSafe becomes an important instrument. So jumping without any further delay on iSafe. So what's really an iSafe? iSafe basically stands for India Simple Agreement for Future Equity. Uh, this simply means that when you invest in a startup, the founders, in lieu of your investment, promises you future equity. So it's a convertible of sorts. However, there is a small amendment to that. This is not equity. This is not debt. It is convertible note, which at a future date, for a specific terms, converts into equity. So basically, for all technical purposes, this becomes a CCPS under Indian laws. However, converts at a later date. And we've kind of basically uh, looked at various things, that various agreements, and we find uh, we've kind of funded first 20 startups in the last year from our fund in iSafes. And why typically iSafes, why iSafes and all that. So basically, uh, we funded class one companies, 20 companies through iSafe, and that's kind of the all the founders put together. We had a pitch day on the 7th, and post that, I'm happy to inform you guys that most founders today who were part of our class one are now successfully raising funds from angel investors using iSafe. So I think that's been a kind of proof of concept for us. Coming back to uh, why it is relevant, why safe notes? So why I safe notes? There are no significant metrics in these startups. So basically, it's difficult to value startups initially. iSafe notes defer valuation to a later stage and makes the deal happen between the founder and the investor. Execution, speed is of the essence. There's very little to negotiate here. Uh, Both the parties don't intend to spend time and get the startup funded once decision is made, and more so not involve too much of costs to kind of incur. There's a lot of cost involved here, especially in the Indian context, uh, where there are funds by startup needed for business, but then eventually a lot of cost goes in drafting agreements and paying to lawyers and consultants, uh, basically compliance. So this is why we need iSafe notes. So in short, I mean, iSafe notes key features are that it's high resolution fundraising, and secondly it's a flexible one document security that kind of takes care of all the points and all the key terms at which you would invest in a startup. So that's precisely it. uh, yeah, so 100x VC, we invested time, energy and a lot of money to kind of have this drafted, suitable for India, and we introduced that in India for the first time. So yeah, I mean, what's in it for the angel investors, right? So this is the obvious question in your mind right now, and I'll quickly come to that. So benefits of iSafe, more importantly, the most important being there is no dilution at this stage when you're investing. So what happens in an iSafe is the kind of terms that you come into. Uh, so let's say you are investing a crore for a valuation cap of 10 crores. Your 10% stake will not dilute till the next pricing round happens. So when the pricing round happens, where there's an institutional investor or a VC invests, your stake gets converted post money of that investment. So there is no dilution that you undergo for whatever investment was made early before the round. So that being one of the biggest benefits. Secondly, because you're early, because you're funding the founder soon enough with speed, you can negotiate a discount to the next round. So let's say if the founder is planning to do a next round at a higher valuation, he obviously there's all logic to kind of negotiate a discount with the founders for the current round that you are participating in. So there's a very clear logic about negotiating a discount, which eventually obviously translates into an economic benefit for the investors. Yeah, so speed wins. You can basically beat other angels or networks who probably take a lot of time to kind of close deals, VCs, institutional investors, where there's a lot of diligence that takes place, and even after term sheet, that by the time the money comes into the account, it is basically 3 to 4 months. So you enter the right company, having done the business diligence and the founder diligence, you can actually close deals much faster with founders, and iSafe basically allows you to do that. Also, because it's speed, because the closure happens fast, and the decision is taken fast, and the money is coming in early, founders feel more comfortable dealing with angel investors who are willing to invest through iSafe. So we found in our own class one, would like to share a data point here that post VC pitch day, one of the founders was immediately given a soft commitment on the day, and then after a few weeks of diligence, basically an angel investor ended up with their investment in the portfolio company, and soon after, and while the whole diligence by the VC and the institutional round was going on, the angel basically closed the round with the founder. Hence, two things happened. One, the company became more comfortable in terms of some money in the bank, so that they could extend the runway, start doing what they wanted to do, and not really wait endlessly for a VC round to kind of happen, and that just made him at ease and discuss and negotiate valuations with VC. So the VC round happened, but it happened. It's probably happening now, or probably in some time. But the angels went ahead and closed the deal with the founder soon enough. So that gave an edge over the other investors for angel investors. So I hope I kind of made these points clear, and happy to take questions later on this. So request you to note down the questions, and then we'll take this up after my session. So yeah, there are about 4 or 5 types of SQL Safe, and these are all there on our website. This is open source. We've kind of put it out there on the website, various types of iSafe that you could use uh, with the founders when you're discussing investment. So typically, all of these don't extend beyond 5 to 6 pages. Uh, so I thought probably we'll do a comparison of all of you or most of you would be aware about an early stage kind of standard CCPS term sheet. So how does an iSafe differ from that? So just a broad comparison of a few things. So A, obviously, as we discussed, there is no post-money, pre-money valuation, and hence, too early. So that being the change, and uh, standard CCPs will always have pre-money, post-money. There could be discussions on board seat here. Angel investors most likely are not going to be on the board seat of on the board of these companies. There is no SHA, which is the main kind of driver here. This is just a 5-page agreement in iSafe that you sign. There are very few consent rights instead of the whole long list of reserved rights, reserved matters that institutional investors uh, tend to kind of make in a standard CCPS environment. Uh, at this stage, probably there is less need or no need for an ESOP pool to be created as well, as the startup is pretty early. Uh, and that can happen at a much later stage. Uh, there are no voting rights, which typically happens in a CCPS environment. Founders kind of employment terms. It's more of a consultative affair, and we feel, and this is in our own experience, founders obviously always consult investors and angel investors who are adding value, rather than making it a prior investor consent kind of a thing. So that typically make sure that uh, it all happen in collaboration, and things are discussed well, and there are no paper consents or prior consents that are required. So yeah, there's lock-in period here. So founders typically are going to close around as soon as the angel investors round happens. In an institutional kind of round, some of the vesting and the lock-in period anyway applies in these rounds. So there is no need in iSafe to kind of have those clauses. So by now, you guys must be wondering what's the numbers game here? How does the NICEF translate, convert? What is the end game? What happens when a VC round happens after I sign an ISAFE with the founder? So here it is. We all love Excel sheets, so I've just pretty kind of much made a small Excel sheet which explains how the ISAFE actually works. So I would like you to take you through this and like to focus on this for the next 1 minute or two. Uh, so starting from the left side, when there's a clean cap table with just founders equity, the iSafe kind of happens at, let's say, angel investor comes in with 25 lakhs with a post money valuation cap of, let's say, 7.5 crores, and this is not a fixed valuation. This is the valuation at which they are comfortable to invest and want a cap. This could well work in the favor of angel investors, and let's say the stake is 3.3% translates to now. So, for example, if you really see the red text and the down, Series 1 will be issued. So this is Series 1 CCPS to be issued to angel investor at a premium of 7,321 per CCPS, because the valuation is at 7.5 crores. So the shares of Series 1 will be 341 shares, will be issued to the angel investors uh, for a premium of 7,300. Post that, whenever there's a price round happening, which is the next table on your right, uh, let's say there is a raise of 2.5 crores, and now the terms are pre-money 15 crores and a post-money of 17.5 crores, there's a dilution of 14.3% by the for the new investor. The old CCPS Series 1 then converts into Series 2 because now there is a price round happening. There is a post-money valuation of 17.5 crores. So each of the Series 1 investor angel converts into a Series 2 CCPS, assuming the second investor is coming through CCPS. And the table on your extreme right shows how much shares would each investor get in the end game. So thereby, retaining the percentages of 3.3 respectively for the angel and 14.3 for the investor. So that typically is how a price round converts an angel investor's CCPS into a series 2 or an equity, whatever the case may be. So this is how typically it works. The number of shares, if you really see the yellow highlighted cells, from series 1, 341 shares, the angel investor ends up getting 400 shares of series 2, which then is valued at whatever 17.5 crores. And so that then becomes, then the cap table becomes clean in terms of everybody having a conversion ratio of 1:1. So now just let's just come to the questions, and I've received some questions, so I'll try to address them in the following slides. So how does an investment actually happen? The investors and founders agree on the investment amount. They sign an iSAFE agreement after obviously the whatever the secretarial formalities at the MCA or ROC take place. An outstanding iSAFE would be referenced on the cap table just like any other convertible security. Coming to the liquidity preference, yes, iSafe note holders are treated like preference shareholders and have liquidity preference over founders or equity holders. And they also have pari passu rights with other safe note holders. So all safe note holders will have pari passu liquidity preference rights. And the lastly, so how is it reflected in the startup financials? These are reported as CCPS. So in the equity and preference share capital, the amount gets reflected, and the obviously for issuing CCPS, a company will have to kind of raise their authorized capital a bit to kind of accommodate the face value of the shares issued, not the premium. So the rest of the amount will be reflected in the reserves as the share premium. So that's typically how iSafe note accounting happens in the books of accounts. And that's probably the way, I mean, your CA or consultant will basically tell you that. Um, so yeah, I mean, typically a little bit of background on why, this was inspired from Y Combinator. I think most of us know what Y Combinator is. It's a big accelerator out of US, and they were the ones who introduced safe notes in 2013. And YC has invested in companies so far, more than 2,000 companies. Some of the names, as you can see, are world-leading names, unicorns, top companies, valuations running into billions, and over 100 companies valued at more than 150 million. So post YC pitch day, as we just said about our pitch day, most investors invest in YC funded startups through a SQL safe on the lines of what I just discussed with you in the previous slide. So we saw this model hugely successful, and hence Sanjay Mehta, who is one of the founder partners at 100x, has been investing in the US companies through safe notes, and this is exactly why we thought this was a good time to introduce safe notes in India and have a similar kind of ease of convenience, speed of investing enabled in the Indian ecosystem as well. Uh, so yeah, I mean, we've already been talking about iSafe all along, and it's been really applauded and covered by the media, as you can see, right from the time that we launched. Forbes kind of covered that. There was an Inc. 42 Your Story article. Business Line just covered us. So basically, they all now feel once we are kind of making this awareness across all the stakeholders, we've been also having inquiries from founders who probably are raising funds outside of 100x have also kind of started using iSafe, and we are happy to note that there have been a couple of transactions, and these guys got back to us and said, the iSafe has been extremely useful uh, to kind of get us our fundraise. So happy to note that, and we really want this thing to kind of proliferate and more funding happening through iSafe. That would probably help more transactions, help more startups getting funded. So yeah, I mean, coming to the closing remarks, iSafe simply means investing simplified. Uh, Happy to take suggestions, queries. This is my first masterclass on iSafe for angel investors. We've done quite a few for founders, but this is the first one for investors and family offices. So happy to kind of receive inputs, suggestions, queries, questions. Please feel free to write to me uh, at Yagnesh at the rate 100x.vc. And so that's about it. That brings me to the close of my uh, presentation. Would request Vatsal to my colleague to kind of help us with the questions, if any. So, guys, you can pose your questions. Happy to kind of answer them for the next 10 minutes. So yeah, one of the questions that have come is that what are the steps involved once we have executed the iSafe from a compliance perspective. So few steps that founders and investors would have to do is obviously share their KYC details for the founders and the startup to share with their consultants for filing. There are some steps before iSafe agreement is signed, like increasing your authorized capital, preference capital to accommodate the face value of the shares issued. Secondly, obviously, once the iSafe is signed, there are a few filings that have to happen, and if it is a valuation cap, there have to be a valuation report as per the laws of company law, where a registered valuer would have to issue you a valuation report. This can be easily arranged by consultants across, which will bring the share premium value that is stated in the iSafe agreement. So that is typically what happens, and then the relevant filings are done at the ROC, hence the CCPS share certificates are issued once all the formalities are taken care of and the allotment procedures are done. So that typically are the compliance procedures. These are shown, as I said earlier, in the finance accounting of the startup in the share capital and a premium space where this is reported. So that's where it is reported in the accounts of the startup. Uh, One more question that I have received is raising capital using iSafes would be cheaper than convertible debt in terms of legal and other costs. Certainly. So as I said, once you raise money in convertible debt or direct equity, it will involve if it's valuation involved pre-money, post-money, then you end up signing an SHA. It's a 50, 100 page document. You will definitely need a lawyer from your side, and the founder will need a lawyer from their side. All of the cost is going out of the startup's balance sheet. So remember, whatever you're funding, a significant cost shouldn't really go in paying lawyers in terms of getting the agreements in place, and that's typically why we've had a simple 5 to 6 page agreement, which basically takes care of the important rights that an angel investor should have in the investment, and that's precisely it. So one more question is that for how many months can iSafe notes be issued? So typically CCPS under Indian laws can be issued for 20 years. However, there can be an agreement between the founder and the angel investors that iSafe notes are valid for, let's say, 3 years. And let's say if there is no funding happening in the company for 3 years, uh, typically, so if the company is not raising capital in 3 years, in all likelihood, probably the startup will close down or will go bust, and hence we at 100x we convert our iSafes into equity at the extension of 3 years. So as soon as 3 years expire, the CCPS gets converted into equity if there is no fundraise happens or no conversion of iSafe happens. So this translates into whatever is the pre-decided equity that both the founder and the investor has agreed. So that's typically our time frame. And yeah, legally you could have a 20-year period, but that's too long a period for it to continue. So a lot of outcomes will happen in most cases in a matter of 1 to 3 years. So that's one of the questions that came in. So uh, happy to kind of answer any other question. So one more question that has come in uh, is that uh, is the general period 12 to 24 months? So yeah, I mean you could decide a period of 2 to 3 years. Compulsory conversion happens only if it is pre-decided and written in the iSafe. So if the iSafe states that the conversion in case of no conversion happening to equity on a fundraise round should happen into some percentage of equity at the end of 3 years. So if you have those terms pre-decided, then it is always safe to kind of keep that clause inside this iSafe and sign the iSafe agreement. So, guys, that's about it. I think I have all the questions answered. However, please feel free to kind of write to me at Yagnesh at the rate 100x.vc again. Happy to kind of answer the questions. And again, thank you very much, guys, to find time on the Saturday and join this webinar. Uh, Look forward to be in touch. Thank you so much.